Welcome back to the channel, Survive and Thrive. And today I'm going to focus on a company in the artificial intelligence industry. And I know for many of us as investors, we're looking for that next place where the company trends could go so that we can get in now to be able to build wealth in the next 5 to 10 years. And I think artificial intelligence is one of those disruptor industries that we really need to take a look at. Diving into this deeper, the company I'm focusing on today is C3.ai, ticker symbol AI. And jumping to their website, you will see just how well evolved they are and the presence that they're trying to make across the globe. Unify all your data, build AI models, deploy critical AI applications. 849 unique enterprise and enterprise source data integrations, 4.8 million AI models in use currently. They run these AI models at scale for powerful predictions across the most complex organizations. And so I do see this company very similar to Matterport, ticker symbol MTTR. And I've done quite a few coverage videos on that company as well, because I think that both of these are in the disruptor industry, but they also serve a greater purpose in many different business developments and not just one specific niche industry specifically. 1.7 billion predictions per day. They offer more than 20 pre-built industry-specific AI applications to optimize critical processes. And doing some additional research on where they are from a price per share standpoint, as well as overall in the stock market, this Motley Fool article, Why C3.ai sank 14.9% just last month. So this would have been in February 2022. A report from a short-selling firm triggered significant sell-offs for C3.ai stock, and shares have continued to move lower. The AI stock is now down roughly 36% across 2022's trading. Shares of C3.ai gained 26.2% in November. According to data from S&P Global Market Intelligence, the stock lost ground amid selling pressures for growth-dependent software stocks and the publication of a new short report. Short-selling firm Spruce Point Capital published analysis on C3.ai on February 16th, indicating that it saw the artificial intelligence stock having significant downside. At the time of the report's publication, the short seller said it saw C3.ai potentially falling up to 40 to 50%, pointing to a price range between $12.85 and $15.40. So what? Against the backdrop of selling pressures impacting the broader market, the bearish write-up from Spruce Point Capital triggered significant bearish momentum for C3.ai stock. The report noted that the AI specialist customer base is highly concentrated, with energy technologies company Baker Hughes accounting for more than 30% of sales. Now that will change over time, and as they become a bigger player and able to address more of the total addressable market, or TAM, I think that they can outpace market growth, gain more of the market share and alliances and business relationships, and be able to close out deals and perform at a very high level. Now what? C3.ai stock has continued to fall early in March's trading. The company's share price is down roughly 10.6% in the month so far. C3.ai published its third quarter results on March 2nd, delivering sales and earnings for the period that topped the market's expectations. Revenue grew 42% year over year to reach $69.8 million, and the business posted a non-GAAP adjusted loss per share of 7 cents. Meanwhile, the average analyst estimate called for an adjusted per share loss of 26 cents on revenue of $67.16 million. The company also raised its full-year revenue guidance to $252 million, representing a 38% increase compared to its previous target. Despite the sales and earnings beats and full-year revenue guidance hike, C3.ai stock lost ground after an initial post-earnings pop as negative coverage from analysts rolled in. There were a couple of analysts that significantly cut their one-year price targets on the stock, and the downward revisions have added to recent selling pressures impacting software stocks and the overall technology industry as well. Is C3.ai stock a buy now? They posted another quarter of accelerating revenue growth. Its gross margins are expanding and its net losses are stabilizing. The stock is still speculative, but it looks cheap relative to its long-term growth potential. And that's really what's got me interested in this company now. I do not currently have holdings, but I am looking to find the right entry point, and it does seem like it's nearing that and could be an excellent opportunity to be able to really load up and build your position for substantial wealth gains in the future. So as we talked about, the AI services provider just posted a strong Q3 earnings report. And just how fast is C3.ai growing? AI algorithms can be plugged into a company's existing software infrastructure to optimize supply chain operations, improve employee safety, streamline spending, detect fraud, and more. It also provides its AI services as pre-built standalone applications. And so that's why I think that it does have a great chance to become one of the leaders, is because it can address so many different industry types and companies out there across the globe. Now, while they primarily serve large energy, industrial, and government customers, its largest customer is the oilfield services giant Baker Hughes, which accounted for 39% of its revenue in the first 9 months of fiscal 2022. Its current contract with Baker Hughes will last until fiscal 2025. So they've got a decent backlog on a majority of their percentage currently. Now, the trick will be for them to really build out a more stable customer base and expand as quickly as they can. As the rest of its customer base, C3.ai ended the third quarter with 50 customer entities, entire organizations, and 218 unique customers, distinct divisions across those organizations, compared to 39 customer entities and 120 unique customers in the prior year quarter. So a significant upscaling, and I think that if they make the right business decisions and are strategic, they can continue on this accelerated growth path. C3.ai grew like a weed in fiscal 2020, which ended in April of the calendar year, but it lost its momentum in fiscal 2021 as the pandemic spread and disrupted the energy and industry sectors. However, its growth accelerated over the past year as those headwinds faded. You can see the year over year from fiscal year 2020 to Q3 of 2022, 71%, 17, 29, 41, and 42 respectively. And as discussed earlier, they expect to rise 38% for the full year for revenue compared to its previous guidance for 35 to 36%. Analysts expect its revenue to rise 31% in fiscal 2023. Based on those expectations, C3.ai stock looks reasonably valued at less than 8 times per next year's sales. For reference, Palantir, ticker symbol PLTR, the data mining firm that believes it can generate at least 30% annual revenue growth through 2025, trades at 12 times this year's sales and 9 times next year's sales. So I think that, in my opinion, C3.ai is a better price per share ratio and may have a better customer base that is a little bit more predictable than what Palantir has been doing, focused on government contracts. Expanding gross margins and stabilizing losses, C3.ai remains unprofitable by both generally accepted accounting principles and non-GAAP measures. However, its non-GAAP gross margins have continuously expanded over the past year. And you can see that in the chart here below. Those margins are in line with those of comparable industry peers like Palantir, which reported a non-GAAP gross margin of 83% in its latest quarter. Now, this ongoing gross margin expansion can be attributed to its higher margin subscription business and its improving scale. Those expanding margins are also suggest that C3.ai has plenty of pricing power in its niche market for integrated AI algorithms and applications. They ended the third quarter with $1.02 billion in cash equivalents, and short-term investments, so it can easily afford to rack up more losses as it expands, which is a great place to be. So that will help them to make those acquisitions as needed to really scale and be able to bring in more revenue and expand on their customer base. Its low debt to equity ratio of 0.16 also gives it plenty of room to take on additional leverage. Still a speculative play with lots of upside potential. So I am not a licensed investor. I'm doing research on my own and making my own opinion, so you should do the same. This stock is not for queasy investors. Its customer concentration issues are still worrisome. It lacks a clear path toward profitability, and it could be disrupted by similar AI services from larger cloud service providers. That said, the stock's low price to sales ratio could limit its downside potential as it gradually expands. Its low enterprise value of $1.3 billion could also make it a tempting takeover target for a bigger tech company. In short, I think C3.ai is worth nibbling on at these levels. This particular author was not a fan of this stock when its valuations hit irrational nosebleed levels in late 2020, but the risk-reward ratio now looks much more compelling. So if we jump back over time, you can see that there's been some significant increases since they went public in December of 2020, going as high as $161, which I believe is their all-time high. And now we're down 84.95% at the $18 per share range. So for me personally, I'm looking at this one for the long term, and I think it's one that's going to be one of those players. If they do get bought out, I think they are still a contributing factor to the AI industry, and it's those disruptors that you really want to be a part of. And so would love to hear thoughts and comments below specific to the AI industry and C3.ai specifically. As always, if you've gotten value out of this video, make sure to smash that like button. Follow me as I continue in this path to financial freedom and wanting to help the YouTube community along the way. Turn on that bell, hit that subscribe button, keep your ears low to the ground, and look for those opportunities to build your wealth as a resource. Don't just survive, thrive!